This is a presentation that I did at Louisiana State University.
Great.
So I'm going to use the same presentation.
Okay, perfect. We're very happy and eager to get started. So we're going to get started in about 7 minutes. Everything looks fine on your presentation. I think we're able to see probably. You'll have to shrink the screen a little bit just so we are able to see everything on that presentation and maybe move it a little bit down.
Can you see it now?
Yes, I can see it now. Now I can, if you could fit the presentation to the screen.
Okay,
Is it in?
1 second.
Mm-hmm.
It is fit to the entire screen. I'm
Okay.
in presentation mode. Let me see if I could get into presentation mode.
If not, you can just exit presentation mode and just leave it to the slide on the screen, and then we'll be able to read it all from there.
Okay. Just a minute. Let me see if I screen, back screen, wide screen, point options, use point of view, set, and show by title.
Can you click on screen, see if it allows you to give?
Just 1 second. I'm trying to see if I could.
Okay.
Is that any better now?
We're only able to see half of the slide.
Okay, which half are you seeing?
Well, right now I can see the wheel. I can see part of the triangle. Well, now I can see that little square.
Okay.
But unless you move it, but if you exit the presentation and just leave the slide, does that allow you to do that?
Yeah, I could do that.
Mm-hmm. I think
It's
it'll
just
be
that
better.
I can see a lot better when I have.
Oh, okay.
Just a second. I'm going to try to see if there is a way to. Okay, let's see this. See, in this mode, you could see all of it?
We could see all of it, yes. And I can see all the content per slide.
Just 1 second. 1 second. I'll change the way I've shared.
Okay.
So let me quit some things here.
Mm-hmm.
Quit. Quit. And so everything I have is gone. So I will stop sharing for the moment.
Okay.
And then I will share. Whiteboard desktop. Let's see the shared desktop. Let's try this and see if that works. The only thing about it is that it's going to. One second.
Mm-hmm.
How about that? Is this any better?
No, it still zooms in way too much, so we're not able to see the entire slide.
Okay. Okay. Stop sharing and then I'll share something else and see if that works. If it doesn't, I'll go to plan C.
Okay.
Okay, you're seeing it right now?
Yes.
You're seeing the full?
If you'll probably have to be scrolling up and down just so we can see it all, but it'll be easier for you like that to read, right?
Yeah, that's gonna be fine. It's not in presentation mode.
Mm-hmm.
But let me see something. There probably is something on custom show. I'm using a Mac, that's why.
Mm.
Oh. Just dawned on me I could have used my other computer, but that's okay.
That's okay. No worries.
I'll just go ahead and go from slide to slide. The other way I would be able to just click my mouse and move, but now I'll have to go from just navigate manually from slide to slide.
Whichever is easier for you.
Yeah.
That's fine. Yes.
If you're not seeing it, the easiest for me would be
to have it in the show,
to have it in the show, slideshow mode. But if you're not seeing some of the screen, then it doesn't make sense to do it in that mode.
Right. Right. Well, I guess we can do it like that. Well, we're already 3:01. My time, it should be 1 p.m. time of the conference. So we're going to get started. Welcome, everybody. It is my pleasure to introduce you today to our today's special guest, Thomas Calderón. Welcome, Doctor. Thank you very much for your time and for sharing today some of your knowledge with us. Dr. Thomas has a PhD in business from the Virginia Tech back in 1987. He also has a major field in accounting and minor fields in finance and statistics. He will be today presenting us the topic Milestones and Cutoffs, Use of Available Analytics to Identify Red Flags. So without further ado, I'll leave you with Dr. Calderón.
Thank you for offering me the opportunity to present. It's always a little awkward to have a presentation and not know the people that you're talking with or how many people that you're talking with. But it's something that I've done before and I enjoy presenting, so that's not going to stop us from having a good presentation and perhaps some discussion as well. As I go through this presentation, if you have a question, feel free to stop and ask your question. Depending on the number of people that we have in the in the presentation, we may be able to have something like a dialogue session as opposed to my talking all of the time. So it really depends on the number of people that we have. This presentation is a presentation that I did at Louisiana State University not too long ago as part of the fraud conference. And I thought it would be very appropriate to do this particular presentation for the group. In this presentation, what I'm going to do is talk about what I call milestones and cutoffs, and the tools that might be available to facilitate assessment of milestones and cutoffs in identifying red flags in an accounting and business setting. The sort of red flags that I talk about are probably very much appropriate for internal auditing as well as external auditing. But it could be used, the whole concept of a milestone and identifying red flags around a milestone. That concept could be used in practically any business setting. Essentially, there are many, many different milestones in business, many, many different periods that we use as cutoffs for assessment of different things. For example, it could be something as simple as a cutoff for determining the measurement of your sales. It could be something a little more complex, perhaps something like a cutoff used to measure profits for a major contract that you have with a bank. Typically, those types of contracts are referred to as either debt covenants or simply contract covenants. So there are many different types of cutoffs that you're going to encounter. But for the most part in accounting, when we talk about cutoffs, we are usually talking about the end of a particular period and making sure that transactions are accounted for within the period that they belong. That's in essence what we mean by cutoffs in accounting. In our presentation today, I'm going to talk about some routine applications of analytics. My emphasis here is not necessarily financial analytics, but big data analytics, how we as end users are essentially being subjects of analytics, not necessarily individuals who are doing the analytics and using the analytics data, but we are subjects of the analytics. In other words, someone is using data about us to make decisions that help them in business. Then I'm going to talk about whether or not this whole concept of analytics is new to accounting. We'll discuss an analytics typology. Once I discuss the analytics typology, I think we'll be all set up to talk about how we could combine this whole concept of analytics with the concept of milestones and cutoffs that we know so well in the context of accounting. We will discuss available tools, and finally I'll close with a few examples of how milestones and cutoffs might be used in business settings. And these examples are actual real examples that a firm might adopt or auditors might use. As I said, we are starting off with examples of how analytics are used in business and how we are essentially subjects of analytics. Not necessarily the consumers of analytics, but we are the subjects of analytics. People are using our data to make decisions, make data-driven decisions. Now, the interesting thing about this particular slide is that it reflects what I typically refer to as data at source. And because there is a lot of data at source, companies are able to collect that data and use that data for data-driven decisions. So in this particular case, you could think of, let's say, me traveling to Orlando, Florida, renting a car, trying to use my credit card at a gas station, and the gas station essentially prevents me from using my credit card to purchase gas. And the reason that would happen is because my credit card company has my profile on its network, in its database. My profile is connected to its customer relationship management analytics, and the customer relationship management analytics essentially says to the system, to the credit card company system, wait a second, Thomas Calderón is not, he doesn't really regularly do business in Orlando. We have never seen him purchasing gasoline in Orlando. Therefore, we should essentially ask him to stop, or ask the person who is using his credit card to stop. Well, the interesting thing about this is that Thomas Calderón is a subject of analytics. He can't purchase gasoline because the analytics that is collected, or the data that is collected from him during his regular purchasing activity, that data is essentially being used to predict what he's going to do and whether or not, and assess whether or not it is likely to be him who is purchasing gasoline at a gas station in Florida. The second example of data at source. This one is becoming, it's sort of a little highfalutin, but it's becoming a little more common. This is an example, once again, of us using a device, and that device is facilitating data collection by the manufacturer, or perhaps by someone who sells services related to that manufactured product. Well, in this example, what you're seeing here is a gentleman or a person who is brushing his teeth. He's using a smart toothbrush. With those smart toothbrushes, there is an app that is connected to the smart toothbrush, which allows the individual user to do many different things or see many different things. So with this particular app, the user could see where on his teeth or in his mouth he brushes the most, where he brushes the least, how much time he spends brushing his teeth. And of course, if he fails to brush his teeth, that too becomes a record. Well, as a subject of data analytics, somebody is collecting all of that data at the source, and we allow that person to collect all of that data. That data goes into the customer's profile. The company's customer relationship management analytics analyzes the patterns, the brushing patterns of that individual. It uses the data for predictive analytics, and it tells someone whether or not the user brushes regularly, whether or not the user overemphasizes various areas in his teeth or her teeth. And then, of course, in this particular case, what you're seeing is that the data analytics, the results from the data analytics could be shared with a dentist. When that user goes to the dentist could say, okay, I see that you do not brush your teeth regularly, or I see that you brush your teeth very regularly, but you tend to overemphasize the right side, you underemphasize the left side, you never brush the front of your teeth properly, etc. All of that analytics could be captured and shared with your dentist, and your dentist could assist you in essentially becoming a better dental patient. But what is also interesting about this particular data at source example is that the maker of the toothbrush could monitor all of your activity and then tell you when it's time to replace the toothbrush head. So in essence, they're using this to help you with your dental habits. They're also using it to sell items to you. So this is all part of what we are seeing analytics being used for. Another way in which analytics is being used in corporations, and it's being used pretty widely for that purpose. Here, you have a corporate P card, basically a credit card that the corporation gives out to facilitate purchasing and expenses, payment of expenses by employees who are authorized to make such purchases. So in this particular case, you have an employee with a credit card who goes ahead and purchases flowers using the credit card. Now, at many corporations, and in public entities, the purchase of flowers is a disallowed purchase under normal circumstances. So in this case, what would happen is that the credit card company and of course the institution, the organization, would have your profile in its database. And the system could tell whether or not you are authorized to purchase flowers. Well, if you're not authorized to purchase flowers, which is usually the case, the system is going to send you an email to say, wait a second, you purchased an unauthorized product utilizing your credit card. You are hereby warned. If you continue to do it, then the system may send you a red flag and say, hey, you're forbidden from doing this. And so the system automatically escalates a situation where a customer is using a PC card to purchase unauthorized products over and over again. Eventually, what's going to happen is that the red flag is going to be sent to the employee's supervisors. The supervisor is going to take action, and it could be something that actually gets very bad. Needless to say, this is another example of data at source and how companies are using analytics to make predictions and also to diagnose what's going on. Here's another example of how corporations are using analytics. Here you have an individual who is driving a classic car, okay? Doesn't matter where this individual is driving that car. What matters is this individual, the driver's profile, and the fact that the driver has a contract with an insurance company that requested permission to install a little device to collect data on the customer's driving habits. So the insurance company collects data, literally everything that you do with regards to your driving habits, let's say for 30 days. That data goes into the customer's profile. It also goes into feeds into the insurance company's risk management application. Based on that data, which is being picked up at source, the insurance company may say, wait, this individual is a good driver. He's a better driver than the driver that we expected him to be. As a result, we are going to lower his premium. Or the insurance company might say, hey, based on the data that we have collected and based on our analysis, we predict that this driver is going to cause many accidents. This driver is a bad driver. In fact, this driver is a worse driver than we anticipated him to be. So as a result, the insurance company increases the individual's premium. Notice what's happening in all of these cases. In every one of these cases, we are volunteering to share our data. In other words, share data at the source, okay? And an entity is taking that data using some sort of analytics model to either diagnose, to predict, or in some instances to prescribe what can be done or what should be done. Now, in accounting, one question that I hear all of the time is, all of this thing new in accounting? Is this new stuff? And what I would like to say is that it's not new. We have seen a lot of analytics being used in accounting, but we never really called it analytics per se. We essentially called it something like statistics. We called it statistical analysis. We called it data analysis. And more recently, we called it data mining. But it's not necessarily new. What is new and what is interesting is this whole phenomenon of data at source. And so businesses have a lot of data about practically everything that pertains to their business entity and to their customers and other stakeholders. In addition, there are many user-friendly tools that businesses can use and employees of businesses can use to leverage the data that they have. So for example, let's take a tool like Microsoft Excel. That tool is very user-friendly. Practically everyone who has a college degree, has in accounting in particular, has exposure to Microsoft Excel. They can use Excel. They could do some very, very fancy things with Excel. But Excel data could be input for many other user-friendly tools that are more analytics friendly. So for example, I could use my Excel data, put my Excel data in a tool like Tableau, or put my Excel data in a tool like Microsoft Power BI, and use and obtain some really great analytics that could be used almost instantaneously. And you'll see what I mean by that later on. Artificial intelligence is a lot more commonplace. We have, again, continuous and efficient creation of big data, particularly with the phenomenon of data at source. We have very, very easy access to big data. It's not like in the old days where to have access to data, you actually had to be at the site where the data was being stored. Now you have access to data via the cloud. And there are many, many tools that facilitate easy access. You also have very easy access to inexpensive hardware for storage. On my computer, I have a total of 11 terabytes of storage right on my physical computer. 11 terabytes. That is a lot of data capacity. Well, if you go back 10 years, to get 11 terabytes on a computer, particularly a personal computer, you would have to be spending thousands of dollars to get that kind of data capacity. Well, now it's easy to get, it's easy to move around, and then my 11 terabytes of data could be visualized and analyzed relatively easily. What is interesting, perhaps most interesting about the availability of data, the availability of user-friendly tools, the availability of artificial intelligence, etc., is that there are many attractive business use cases that organizations are exploiting. As an example, let's take this individual brushing his teeth. Data is collected about the individual's habits. Later on, the company sends that individual an email saying, it's time to change your toothbrush heads. That's phenomenal because now you are using data created by that individual to help that individual make a purchase decision. Now, these business cases usually have very significant value propositions and they constitute the basis for revenue models. In accounting, much of what we have talked about here can be applied. Before I get into applications in fraud risk assessment, let's look at a little analytics typology, because this typology is going to help us in terms of identifying the capabilities of analytics. Analytics could be descriptive, diagnostic, predictive, or prescriptive. In fact, the analytics tools that are available these days could help with practically every one of those functions: describe, diagnose, predict, and prescribe. However, what you do with your analytics tools or what you do with your analytics capacity really has to do with the mindset of the business. So someone or an entity might be curious about just basic questions. For example, a basic question might be, what is the average size of each warehouse that we have, size in square feet? That's a very basic question. Or what is the average age of our customers? Or in which locations do our customers reside? Or for how long do our customers utilize the automated toothbrushes? And how long after the prescribed period do they renew their toothbrush heads? We could ask some more critical questions or more formal questions. We may be curious about, for example, do customers who use smart toothbrushes, do they brush regularly? If they brush regularly, do they have more teeth or dental problems than people who do not brush regularly? Or we may ask questions like, for companies that sell smart toothbrushes and use those smart arts, do they end up selling more than companies that do not use those smart arts? That's sort of diagnostic. But in some instances, we may be curious about patterns, we may be curious about relationships, we may be curious about solutions. In other words, for those people who do not brush regularly and who could purchase toothbrush heads a little more often, what can we do to nudge them into that type of behavior? Buying toothbrushes a little more often, toothbrush heads a little more often, brushing more regularly, etc. And then at the highest level, in terms of the mindset, we may be curious to let the data find hidden nuggets and literally drive solutions for us. So analytics really depends, or use of analytics, effective use of analytics, really depends on asking questions, asking deeper questions, getting useful answers, and being more data-driven. So in this particular analytics typology, what you're going to find is that many accountants are at the curious about answers to basic questions and curious about formal semantics and critical observations. That's where most accountants are in terms of analytics. We are just beginning to move to the higher level mindsets. Some people call this algorithmic thinking, the higher levels of algorithmic thinking. Here, we are combining milestones with cutoffs. The point that I'm making here is that when you look at accounting data, or when you look at accounting transactions or accounting events and activities, they usually occur either within cutoff periods or close to the end of cutoff periods. Transactions that occur close to the end of cutoff periods could be very, very interesting from the standpoint of analytics, or even from the standpoint of fraud detection or error detection. Close to the end of a milestone or close to the end of a cutoff could signal very, very, very important red flags. As an example, a company might have a big loan with a banker. The banker might stipulate certain debt covenants. One of the debt covenants might be your company has to earn a return on total assets of 7%, or has to earn a return on total assets of 9%. Well, the company might have an incentive to do things that are fraudulent around milestones and cutoffs in order to meet those thresholds. So the question that one could ask and perhaps answer utilizing analytics is, given the company's context, does the data show any incentives or any motivations to commit fraudulent acts in order to achieve a milestone, let's say a return on assets milestone around the cutoff? Now that's useful information to know, because based on the fraud risk standard in the United States and in other countries, we know that fraud occurs in situations where people have opportunity to commit fraud, or in situations where there is pressure. For example, the pressure to meet a milestone, or in situations where individuals could rationalize their behavior. Well, one of the ways that analytics could help us utilizing this particular triangle is that analytics could help us to identify potential pressure to commit fraud. And you'll see how I apply this with our milestones and cutoffs modeling in a short while. Here I give a couple of examples of milestones and cutoffs. So one example that I have here is a cutoff date for the measurement of a significant metric. So the cutoff date for measuring income, or the cutoff date for measuring sales, or the cutoff date for measuring production. End of an accounting period, a month, a quarter, a year. The due date for a significant obligation. Effective determination or date or termination date for a significant contract. Effective date for an accounting policy change. Cutoff date for significant valuation. Cutoff date for debt covenants. All of these are milestones and cutoffs that we work with as accountants practically every day. One of the things that we do not do, however, is that we do not necessarily associate those milestones and cutoffs with data analytics or with incentives to commit fraud. For the most part, we know that we have to do cutoffs to make sure that accounting transactions are accounted for within the correct period. We know that management may very well inflate earnings, but it's very seldom that we identify specific milestones or specific cutoffs with potential illicit behavior. One of the examples that I'm going to use is a cutoff period for debt covenant. And in that context, and in the context of the analytics mindset, my question would be, is there any incentive that management feels, or is there any evidence, that management feels undue pressure to meet a debt covenant around this milestone? So we have a cutoff period for measuring a debt covenant, and we are interested in the question, is there any evidence that management feels undue pressure to meet a debt covenant around this milestone? Now, having identified this particular cutoff, this particular milestone, the question, the analytics mindset question is, what does the data say? We are going to allow the data to speak for itself. A second question that we might be interested in is there any evidence that management's behavior has changed around this important milestone? And the analytics mindset would essentially phrase this in the context of data. The data-related question is relatively simple. The data-related question is, what does the data say? And because of the fact that we collect a lot of data, other entities, third parties collect a lot of data, and there are tools that could help us answer these questions, we could indeed utilize analytics to answer these data-related questions. What does the data say? There are several tools that we might use, and these tools are widely available. For descriptive analytics, many have used ACL, IDEA, and Microsoft Excel. These tools are available. Most accountants use at least a couple of these tools. For diagnostic, we could continue to use ACL, IDEA, and Excel, but we could go to tools like Tableau, Power BI, and Looker. These are slightly more powerful in the sense that they were created to help visualize data and make predictions or diagnose problems based on visualizations. I will use, in a few minutes, I will use Tableau and Power BI, or show you output from Tableau and Power BI utilizing Excel data. If we go to predictive analytics, you could find tools like R, which is a very, very powerful analytics tool. It's open source. It requires a lot of coding, so it's not as easy as using, let's say, something like SPSS, which is also very powerful. It's not open source, but it's menu driven, and most users could pick up on SPSS relatively quickly. Cognos, SAS, Stata, CART, simulation. These are all tools that could be used for predictive analytics. Just one word about CART, classification and regression trees. This is one of my favorite tools. It is my favorite simply because of the fact that the tool could create very powerful decision trees to help management make decisions, or to help management predict activities or predict behavior or predict events. At the highest level, where we combine tools such as R, SPSS, Cognos, SAS, Stata, with AI, as well as with human judgment. At that highest level, we could actually prescribe how individuals should behave, or how we should pursue activities, or how businesses should behave, or how businesses should pursue economic activities. So this is a set of tools that are available, and most of these tools, or several of those tools, I should say, for example, ACL, IDEA, Excel, Tableau, Power BI, a lot of these tools are currently being used by accountants. Let me flip here. And what I'm going to do with this is just give you a little bit of context. This is output from a diagnostic application of analytics. I created this diagnostic dashboard utilizing Microsoft Power BI. And in this situation, I had about 12,000 rows of transactions data. Those were all accounts receivable data. And my interest was trying to use this whole concept of milestones and cutoffs to see which transactions might reflect red flags. And in statistics, we have for the longest while used a normal distribution. We have computed a z-score from the normal distribution or a t-score from the t-distribution. And we could test whether or not an item in a sample is a systematic part of that sample. Well, what I'm doing here is applying this z-score concept. Basically a concept that many people would apply in elementary statistics. In this data set, my goal was to isolate all transactions that occurred around cutoffs. And what I would do is to investigate those transactions. But when you're looking at, let's say, 12,000 transactions in a business, it's very difficult as an accountant to go to all of those red flag transactions or identify all of those red flag transactions in the first place. It's very, very difficult unless you use a tool. Well, in this case, I'm not only using a tool, I'm also visualizing what those transactions look like. Now, my dashboard has a lot of flexibility. My data went from, I think the data set that I had 2 years of transactions. It could have had maybe 10 years of transactions. It really doesn't matter because the tool could handle as many transactions that I give it. But one of my first tasks in building that tool, or this tool, was to ensure that I filter on year so that I have the appropriate year of available transactions. So I filtered on the year to 2016. The second thing that I did was to filter around transactions that were definitely cutoff or milestone transactions. And I defined cutoffs or milestones as transactions that occurred 5 days before or 5 days after the a month end. And as you could see, I have transactions from 12 months because one of my other filters is to identify the month where the transaction takes place. So in this filter right here, the filter that's marked transaction month, I could drag my filter so that I look at any month that I wish. So I could look at January and only January. I could look at February and only February, March and only March, etc. Or if the company's year end is a December year end, I might want to focus only on the December year end. Well, a further thing that I did is that I can filter on my z-score. My z-score might go from, let's say, 0. Absolute z-score might go from 0 to, in this case, the highest z-score that I have in the data sample is 4.61. So my z-score might go from 0 to 4.61. Well, what I'm interested in is z-scores that reflect a transaction that does not seem to be normal, a transaction that is clearly a red flag transaction based on statistical evidence. So I filtered to exclude transactions that have a z-score of less than 2. And finally, I can filter on any specific date that I wish. In this case, I decided not to filter on any date, but to allow the data to speak for itself based on a 31-day month. And I went from 12,000 transactions to 42 transactions that are red flag transactions. So these are statistics, this is an example of diagnostic analytics. And these transactions, of course, are transactions that the auditor might want to focus on in exploring fraud risk. Of course, there are other things that the accountant or the auditor might do. One tool that is often used in auditing and accounting is Benford's Law. You could do the same thing here with Benford's Law. And the beauty about this type of tool, this type of dashboard, is that it's dynamic. I could expand the Z-score from 2 to, let's say, 2.5, or I could change the months from month 1 all the way to month 12 to something like only month 12. And of course, the number of transactions will go up or down depending on what I change. Now, here's the other thing that is interesting, because this tool is actually dynamic. I could decide that I no longer want to look at just the cutoffs, the milestones and cutoffs. I could take a look at all of the transactions that are red flag transactions simply by playing with this cutoff transaction indicator. My cutoff transaction indicator could either be a 1 or a 0. If it is a 1, it means that it's the 5 day before, 5 day after type of transaction. If it's a 0, it simply implies that the transaction occurs within the month, not necessarily around the milestone. So this tool essentially allows the auditor to focus on transactions that may be suspicious. It doesn't necessarily say that these transactions are fraud or fraudulent. It simply says that these transactions are high-risk transactions given the profile of the entity. I did the same thing, previous one, I did this in Microsoft Power BI. This tool I created in Tableau, which is also widely available. I like both of those tools. Microsoft Power BI would be my preference simply because of the fact that it is free, except if you're going to purchase the Server Edition. The Server Edition allows you to share those dashboards across the entire organization. Let's continue with using milestones and cutoffs, and I'll show you my second of 2 examples. In this example, I'm going to focus on what does the data say with regards to evidence of management pressure, or evidence with regards to incentives for management to commit acts that might be fraudulent. So here's the situation. In this situation, we have a company. And by the way, this is a real company. I do not show the name of the company, and I will not talk about the name of the company simply because of the fact that I don't want to associate the company with any kind of potentially fraudulent behavior. But in this company, I used about 60 quarters of data, 15 years of data. And we have a summary income statement, net sales, cost of goods sold, gross margin, selling and administrative expenses, etc. And one of the things that you'll observe if you look at the entire 60 quarters is that the company's profits, the company's operating income is declining, and the company's total assets and not declining as fast or even declining in the context of the declines in operating income. The company's return on assets in 2016 was 10.77%. It was about the same previously. Then in 2017, it became 7.95%. 2018, it was 7.12%. The company has significant debt. The company is very heavily leveraged. It's a big company, a global company. So the company's debt covenant calls for a return on assets of 7%. And you can see that over the last 3 years, the company has exceeded that expected return on assets. But as an auditor, I probably would be concerned about that declining trend because the company has a debt covenant that requires 7%. Sales are declining, assets, total assets used are about the same every year. And so the company has to do something in order to maintain its 7% threshold. What might the company do? Well, let's see what's happening here. In terms of analytics, one of the things that I did, I used the data to speak for itself. And the question that I asked the data is, what are sales likely to be next year, which was 2019? What are cost of goods sold likely to be next year, 2019, etc.? And what was operating income likely to be in 2019? So you could see that operating income would be $926,000 based on analytics. Total assets, $16.7 million. And then the return on total assets would be about 5.54%. Hence, the company would not meet or would not satisfy its debt covenant. The difference between the forecasted ROA and the covenant is 1.46. So the question here is, as an auditor, with what level of skepticism, professional skepticism, would you approach this audit task? Would you approach the audit task with the same level of professional skepticism that you approached it last year? Or would you approach it with a higher level of professional skepticism? Well, what you could say as an auditor is that 5.54% is just about 1.46%. And given the fact that this is an innovative company, it is very likely that the company might do something that is innovative, which will assure that it meets its debt covenant. But bear in mind that the company may also manage its earnings very, very aggressively to achieve that task. Aggressive earnings management sometimes might involve management fraud. There are cases in business where companies or company CEOs and their CIOs and their controllers have colluded to create fictitious sales. So we would be mindful of this. So in the spirit of allowing the data to speak for itself, what I did was to run a simulation. In other words, I did 50,000 what if analyses. With 50,000 what if analyses, given my simulation tool, I was able to predict that there is only a 23% chance that this company is going to hit its ROA threshold based on the debt covenant. Now, if there is only a 23% chance that a company is going to hit its return on assets threshold, and the company's literal lifeblood depends on hitting that asset, recognize that management would feel significant pressure to increase their ROA. They would feel significant pressure to manage earnings in such a way that they achieve that debt covenant. They would also have an incentive to manage earnings to achieve that debt covenant. So in essence, what you have are two sides of the fraud triangle. In a situation where you have two sides of the fraud triangle being fulfilled, then the auditor should approach the audit task with way more professional skepticism than otherwise. So you notice how analytics are essentially allowing the auditor to use the data to tell a story. And the story here is not a pretty one. It says that management has significant incentives to manage earnings, sometimes in fraudulent ways. Now, what I have done simply focuses on a couple of visualization tools, as well as a predictive analytics tool. There are many other tools that auditors might use, but the one message that I would leave with you is that dashboards in auditing, dashboards in management could be very, very, very useful for diagnostic analytics, could be very useful for descriptive analytics. It may also be very useful for predictive analytics. So if there is one nugget that you pick up from this session, is that dynamic dashboards could be very useful. A second nugget that you should have picked up from this is that when we approach an analytics task, the analytics task should be defined largely by the questions that we seek to answer. And in many instances, answering questions that are built around milestones and cutoffs could be very, very useful for management and for auditors. Overall, these are my conclusions and, of course, implications. The goal of what I've talked about here is to build a fraud intelligence system rather than merely identify ad hoc red flags. Fraud intelligence system or a fraud intelligence system simply imply that we are going to look at nuanced aspects of the data. And we are going to mine the data in such a way to discover potential nuggets. In trying to do this, we have to understand the business. We have to understand the role of milestones and cutoffs. We have to know what questions to ask. In other words, we have to have the analytics mindset. We have to collect and clean data. Usually that's the most difficult task. We have to use appropriate analytics tools, and we have to use the fraud intelligence system that we create in order to facilitate data-driven judgments and decisions. So overall, this is my presentation to you. If you have any questions, I'd be willing to take a couple of questions. I noticed no one asked questions during my presentation, but I'll be happy to take questions. If you want to send me any emails, let me give you my email address. Here is my email address, tcalderon@uakron.edu.
Perfect. Thank you very much, Dr. Calderón. It's been a pleasure to have you with this very important and beneficial topic. We've learned a lot. I'm sure our participants will probably have questions as they digest the information and the material you've shared. If they don't have any questions right now, please feel free to reach out to Dr. Calderón via email. There's his email on the screen. So is that tcalderon@uakron.edu, right?
Yes.
Okay.
tcalderon@uakron.edu.
Perfect. We will also be uploading the video conference in YouTube. So if you'd like to review the conference later on to reach out to Dr. Calderón with some questions, feel free to do that. I don't know if anybody else would like to add something before we let Dr. Calderón go. Nope. Okay. Well, Doctor, thank you very much once again for your time. We know you're very busy in your agenda, so thank you very much for making the time to share your knowledge with us.
You're most welcome. Thank you for the opportunity to speak at your conference.
Thank you very much. Have a good day.
Thanks.
Thank you very much, Doctor.
You're most welcome, Maria.